Climate change poses new challenges to central banks, regulators, and supervisors. Integrating climate-related risk analysis into financial stability monitoring is particularly challenging because of the radical uncertainty associated with a physical, social, and economic phenomenon that is constantly changing and involves complex dynamics and chain reactions. Here is what Mark Carney, the former governor of the Bank of England, has to say about financial stability risks from climate change.
Since Paris 5.5 years ago, the frequency of extreme weather events has intensified. The dangers of a 2-degree world have become more apparent. The carbon budget has continued to be consumed, and the prospect of climate tipping points has only increased. In other words, the physical risks from climate change are still growing remorselessly. In short, the issue is as urgent as when it was first engaged several years ago. Now, more positively, another tipping point may be underway. In the past few years, in response to growing physical risks, mounting public pressure, and improving economics of many climate solutions, governments have newfound resolve. Almost 130 have now committed to net zero targets, such that last month the IEA assessed that country objectives, not policies, are consistent with a 2.1 degree world, with the objective of COP26 being to keep the 1.5 degree target within reach. Transition risk is also growing, while commercial opportunities from addressing climate change are exploding. So it's now essential to realize our objective for COP26, namely that every financial decision takes climate change into account. And to that end, let me highlight what I view as some of the most important priorities for central banks in order to help mainstream climate risk management. And the first, as Francois Villeroy de Galhau emphasized today, is to secure mandatory disclosure by companies of climate risks based on the TCFD recommendations. The private sector has been doing its part. Voluntary adoption of the TCFD is accelerating, with over 1,500 firms with market capitalization of over $17 trillion now reporting against the TCFD recommendations that were only launched less than 3 years ago. Many central banks have followed suit and are now disclosing and managing their own climate exposures. By COP26, all major jurisdictions should adopt pathways to comprehensive, comparable climate disclosure based on the TCFD. This includes legislated disclosure, such as in the UK and the EU. It includes regimes led by security regulators, such as in Japan and potentially the United States. And for global coverage, it includes the adoption of a new sustainability reporting standards that should be developed and adopted by the IFRS. The second priority is to leverage the growing expertise in the NGFS to build climate risk management skills amongst the central banking and supervisory communities and in the private sector. Managing climate risk requires assessing the strategic resilience of firms to both physical and transition risks through scenario analysis. This, as my colleague Sarah Breeden has said, is fiendishly complicated. Data is still sparse in some areas. Methodologies are new, interdependencies are multiple, and the future path of climate risks themselves are by their very nature highly uncertain. We know that climate risks are different from conventional financial risks. They're economy-wide, affecting every consumer, every business, and every sector. They're global. They're longer term, going beyond the usual 3 to 5 year planning horizon for most businesses. They're unprecedented by definition, so past data is not a good indicator of future outcomes. And they're complex. They need to be sized from bottom up. It's not enough just to have top-down macro models. Now, rather than being overwhelmed by these complexities, authorities have stepped up. From its 8 founding central banks and supervisors, the NGFS has grown to over 90 members, which represent countries responsible for over 80% of the world's emissions, and which oversee 100% of the world's globally systemic important financial institutions, or G-SIFIs. The NGFS is the place to share knowledge, to refine and to improve the approach to climate risk management. And to this end, the BIS, the NGFS, the IAS, and the Sustainable Insurance Forum are launching today a new centralized training platform for central banks and supervisors. The Central Banks and Supervisors Climate Training Alliance, or CTA, will help build capacity in central banks and supervisors, improving the efficiency, effectiveness, and accessibility of climate risk training and knowledge sharing amongst them. It will provide training across supervision of climate risks, climate scenario analysis, and how to reflect climate in collateral management. We hope that it will be up and running by COP26. This development reinforces my third priority, which is to mainstream the use of scenarios in climate risk management, and in parallel to ramp up climate stress testing. The NGFS scenarios were co-designed with the world's leading climate scientists to capture the possible business impact of the different types of climate risk that could materialize over the next 30 years. Any business in any sector can and should use these models as a baseline to test strategic resilience. And because modeling the impacts of climate change is a new field, the models are being updated regularly to reflect the latest science and to incorporate feedback from users. The latest iteration of the NGFS scenarios released today expands scenario modeling to explore further dimensions of the risks. It improves regional coverage and sectoral granularity. They calculate probabilistic losses from acute climate impacts, expand the set of macroeconomic outputs, and improves the NGFS's climate scenario database and portal. Importantly, the second iteration also includes an additional scenario, a net zero scenario that reflects national net zero commitments that have been made to date. And this underscores an important point. At a minimum, boards and risk managers should know what their exposure is if countries achieve their objectives of tackling climate change. We cannot have financial institutions fail if society succeeds. To avoid that possibility, 21 central banks have committed to climate-related stress tests, with 3/4 using the NGFS scenarios in their assessments. And 23 central banks and supervisors have, or plan to have, issue guidance to firms on their expectations of climate risk management and scenario analysis. These initiatives will allow supervisors to size risks across the financial system and explore possible systemic risks and interactions. By stretching horizons, firms will better manage future risks today. To help drive consistency and to increase uptake, for COP26, we're promoting the use of the NGFS scenarios across the financial sector and the corporate sector through initiatives such as the Race to Zero. We're also encouraging the supporting financial market infrastructure, such as credit rating agencies, data providers, and consultancies, to use the NGFS scenarios as a baseline for their assessments of strategic resilience. My fourth priority is for central banks to improve further the management of climate risks in their own operations while respecting their mandates. This starts with measurement and transparency, and it goes beyond the minimum of TCFD disclosure. For example, the Bank of England last year published a measure of the impact of its investments on the climate, suggesting that the corporate bond purchase scheme which purchases a representative cross-section of the UK corporate bond market, is aligned to a 3.5-degree temperature increase. Following a change in its remit last year, the Bank of England has now committed to more actively managing assets to reflect the government's net zero goal. The bank recently issued a discussion paper on how to green their asset portfolio. This is a first for central banking, but given that 126 countries have committed to net zero, my instinct is that many central banks will follow. As the Bank of England sets out, there are really 4 options. The first is to set targets for emissions in the portfolio to help shape future investment decisions and to provide accountability. Second is to introduce a form of eligibility assessments for a scheme that based on, for example, whether companies make TCFD disclosures while they're still voluntary, or whether they have net zero transition plans, or more fundamentally, whether their activities and their plans are compatible with reaching net zero. The third option is to tilt the portfolio to favor issuers that are performing strongly on climate change, based on a scorecard of different climate factors, such as current emission intensity, past efforts to decarbonize, and forward-looking metrics. And finally, there could be escalating eligibility requirements over time, making it clear that firms not on the path must act or face the consequences of not accessing the scheme in the future. This leads to a range of decisions. For example, should the targets be based on carbon intensity of the portfolio or a more forward-looking methodology of implied temperature rise, a metric which converts future emissions in the portfolio into estimated temperature increases. Also, consideration should be given to how should eligibility be assessed in the absence of prolific TCFD reporting or a coherent framework to assess what constitutes a credible sector transition. And these questions go to a much larger issue, which is the architecture of transition finance. And in this respect, the central bank community can draw on the body of work that's being undertaken as part of the COP26 private finance strategy. In particular, the TCFD has undertaken an extensive review of different methodologies for portfolio alignment, with a view to issuing guidance on how to strengthen these measures and to create a more harmonized and comparable approach. The TCFD will issue its consultation next week, and I would encourage all in the financial sector to engage with this process ahead of final guidance being issued in October, just ahead of COP26. In my judgment, these efforts can help define critical portfolio alignment technology for what the world needs, namely financing the transition to a net zero world rather than simply divesting to green portfolios. We need to distinguish and invest in companies that have plans for the transition. Back in the days of the Wild West, the US outlaw John Dillinger used to say that the reason he robbed banks was because that's where the money is. To get to net zero, financial institutions need to go to where the emissions are in order to provide capital for companies that have plans to get them down and on track in the race to zero. In this respect, it will be essential to incorporate the progress that the race to zero, that science-based targets and the transition pathways initiatives are making in converging around the gold standard for corporate net zero transition plans and sectoral transitions needed to achieve our temperature goals. Now, my fifth priority is to embed the voluntary approaches developed to date into the formal international architecture. To achieve a truly coordinated global approach, the baton needs to be passed from the leadership shown by national authorities, collaborating on a best endeavors basis, to international standard setters, such as the BCBS, the FSB, the IAS, and of course, the IMF. Recent progress in this regard is encouraging. I mentioned the TCFD at the start. And last month, the IAIS published supervisory guidance for insurance supervisors. The Basel Committee is investigating the extent to which climate-related financial risks can be addressed within the existing Basel framework for banks. It's identifying potential gaps in the current framework and considering possible measures to address them. The FSB will present a roadmap to the G20 in July, which will set out their proposed work to address data gaps in assessing financial risks, promoting high-quality, consistent disclosures, and monitoring vulnerabilities across the financial system. And the IMF is increasingly including analysis of climate risks in its bilateral surveillance, such as Article 4 and FSAP reviews, and its multilateral surveillance reports. We need more of the same on this front, on an accelerated timetable. And finally, we need to broaden these climate risk management approaches to all corners of the financial system. In particular, multilateral development banks need to fully align their portfolios with net zero and invest to help countries manage climate-related risks. This includes identifying and rapidly scaling blended finance projects that have proved a success in developing and emerging countries. So to conclude, climate risk management has come leaps and bounds since Paris. We have a better understanding of how these risks could materialize. We have the tools and the methodologies to measure and to an increasing extent manage these risks. And crucially, we have the will and expertise of the best in the private and public sectors. Now, we must maintain momentum and mainstream best practice. Markets are still underpricing climate risks, in part because of inadequate data, in part because of underdeveloped risk management practices, and in part because the commitments of governments to enact the policies necessary to achieve the Paris goals is not yet fully transparent or fully credible. By pursuing the agenda I've outlined today, central banks can help solve the first two issues. And because of the resolve of central banks and the growing commitment of the private sector, as evidenced by the $70 trillion committed under GFANZ, governments can have the confidence that the transition can be financed. They can redouble their climate policy commitments, and with time, it will be safe to go back in the water. Thank you very much for your attention, and thank you for everything you're doing.
Thanks so much, Mr. Carney, for your very inspiring speech and really guiding the Central